We have three models. The linear probability model, and this is all credit scoring models. And credit scoring, we have talked about it, but here we are not talking about personal loans, but we are talking business loans using the balance sheet. And we have another model called the logit, and the third one is the linear discriminant model. Now, let me just give you this, maybe this give you big picture here. So this is the quantitative model, which is we have three models, and which I will explain them in a while. We have the linear probability model, the logit model, and the linear discriminant. All of this have calculations and have formulas. And don't worry about this, you know, it looks like, you know, scary formulas sometimes. It's just the way we calculate it is very easy. And then we calculate the Z here and the Z values for both of them. Now, I will explain what those three models. Also, we use absorbed, in this model, we use the data to develop this model. We use absorbed borrower. So if the borrower comes to us, we use the absorbed characteristics to calculate those scores and calculate the proxy of default probability. So we will have a default probability benchmark. And when the clients come with his, we take this numbers from the like the financial reports and started to analyze it, and both the numbers in the model, and there is a benchmark if we are going to give this loan or not to give it based on the characteristics or the financial abilities of the customer. And this is the quantitative part. So we take the characteristics. When we talk about characteristics, we talk about the actually the numbers inside the balance sheet, and I will tell you which ratios we will use. We will establish a factor, and we will establish factors and their importance to the explain of the default risk in these models. And we will improve the pricing of defaulting of default risk and calculate the reserve needs. See, this is actually the quantitative, but also we take qualitative issues to the pictures, like we take the reputation of the, and this is of course, you know, these old companies are very, they have the advantage of this because they have been long time in the market, so everybody know them. We have the leverage, we have to take it into consideration. We have to check for collateral if the customer will give us their factories and lands and their assets. We have also to consider the volatility of the earning. And we have to use also some types of covenants, which means conditions to encourage certain borrower behavior. For example, I can agree with the customer that their leverage should not be increased and keep in the contract and keep within a certain level, so they cannot take loans from other banks or issue another bonds in the markets that will increase their leverage. This is one of the conditions that you can use from the qualitative part. So these actually the borrower specific factors. We also have to consider something out of this borrower issue, which is the quantitative one and the qualitative one. We have to look to the business cycle. Sometimes there is a booming in the country versus a recession. We have to take that consideration. We will have to take consideration of the defaults. Defaults is highly associated with recession, as we know. And the level of interest rate also, we have to take care of it because higher interest rate will lead to defaulting. And I think I have explained it here. So this is three issues. Let's go now to the credit scoring model, which we start with. This is the first model I want you to know about it, which is the linear probability model. Now, the linear probability model will calculate for you the probability of defaulting, not the probability of payments. And based on that, for example, if the probability of defaulting is 2%, you know the probability of payment is 98%. And therefore, if your benchmark is maximum tolerance is 95%, probability of payment, which means 5% you can tolerate, then in this case, this customer will pass and take the loan. But if the probability of defaulting, as I will check for you now, is 6% or 7%, you will reject the loan. And I will show you how it works. It works with these three factors. This is the model, so you understand it. It's like a regression model, as you can see, because there is an error, but don't you worry about it. This regression, if you are not in statistics, don't worry, or on econometrics, don't worry about it. So we want to define what is, so this one is actually given, because this model is a general model, 3%, 2%, 5%. You just change the variables here, the X1 and the X2 and the X3. And this X1 and the X2 and the X3, you extract it from the balance sheet. So what is X1? It's the debt over equity ratio. This is number one, which is you put it here. You don't change the 0.3, which is the coefficient. You don't change it at all. The coefficient, you keep them fixed. It's just the variable you change it. So what is X2? It's the volatility of the borrower earning, which is the standard deviation. And what is X3 is actually the profit ratio. So now, when you take the balance sheet, of course, you can calculate this from the balance sheet and from the history of the volatility. And then the borrower's earning, which means the changes in the income. You can take a few years and see how volatile it is. And you can calculate. If you calculate this one, you will find that this is 0.25, which means what? Which means actually this is the probability of defaulting. This is what I want you to know, the probability of defaulting, which means this customer, according to the data provided and the models, his probability of payment 75%. So I didn't give you here the benchmark, but if there is a benchmark and the benchmark, for example, is 95, you will get this, you will accept this. If your probability of payments, you require it to be 99%, of course, this customer would be rejected. Now, until now, everything is okay. It's just we have one problem with this model. This model can bring you to zero. For example, if I change the numbers and I say now the profit ratio is 90, and then I apply the model, it will become minus. How come minus? It doesn't work from economic point of view or from set point of view. So in this case, there is sometimes where the probability of default can make minus, which means it has no meaning. So in this case, this model, they develop it and they bring something called the logit model. What is the logit model? There is no calculation in the logit model. The logit model is actually trying to limit the BD here. The logit model will give you here two, I don't know whether you are aware of those dependent variables and or independent variables, but the logit model will limit this amount between, they will make it between 1 and 0. So the values, when you calculate it, 1 and 0. So when you calculate the BD, the model itself will limit it between 0 to 100%, which means the BD has to be between these values. So the model, the logit model, will allow you to, it comes over the weaknesses of the probability model. And as I told you, it keeps it between 0 and 1 interval. So in the calculation, we will not have anything less than 0, and you will not have things like minus, and you will not have anything more than 1. So the values of the logit model is just a treatment for this model, and by limiting the values of the probability model, and this is a statistical issue, you don't have to worry about it, and there is no calculation about it. It's just like that. And I want you to understand that the logit model is actually one of the ways to deal with the weaknesses of the probability modeling, of linear probability model, by limiting the values of the probability of defaulting, which is this one between 1 and 0. Okay, now if we done this, we come to the third model, which we call it linear discriminant model. Actually, this model is more advanced than the linear probability model. The linear discriminant model have the z-value, but the z-value have 5 variables and 5 coefficients. So the first one, and also you can calculate it from the balance sheet. So the first one called, you have to take the working capital over the total assets. Then X2 return earning over total assets. X3 is earning before income and tax over total assets. And X4 is the market value equity over the book value of the debt. And X5 is the sales over the total assets. As you can see, all these numbers, you can find them from the company accounting numbers and financial reports. But how the models look like? This is the model. So the model actually will ask you to calculate X1, X2, X3, X4, X5. And then this is the coefficient already. You don't have to touch anything. And this is worldwide type of model, what we call it Eltman Z. We call it Eltman Z, or you can call it, this is the name of it, Eltman Z. The person who developed it is this guy, but we call it linear discriminant model. So let me take an example, and I take this example also in the tutorial. So if you have this data and you calculate the X1, I don't have the data. I think in the tutorial you have this data. So we calculate X1 like this, X2, X3, X4, and then this is how we, of course you can, if we have physical exam, you will have it, and you have always this formula. So you calculate it and you find it 3.04. Now, one thing somebody would say now, how about the benchmark? The benchmark is either between 181 and 299. The z-value has to be between 181 and 299 to consider. It's an area of considerations. Anything over 299, you accept. It's a good company. Anything after 181, just take it off. But the critical area, they call it the critical area between 181 and 299. Does that mean you reject the loan? You consider it. I mean, it needs more discussion. But if you score more than 299, already green. A score under 181, red and rejected. So this is how the discriminant model works. And I think it's, I don't have the data. I just give you the data ready. I think you will discuss it in the tutorial. And I want you to understand that the z-value has 5 factors, and it has to be between 181 and 299 as a critical area. And over that, accept, below that, reject. Within that range of 181 to 299, you consider. Now, let me come to the last slide in this part, and we talk about the weaknesses. So the weaknesses of the linear discriminant model, which is the Eltman Z, there is a broad distinction between borrower categories. So that is good and bad borrowers. So anything under 81, we say bad. Anything over 299, we say good, which means it's big ones. It's a very broad distinction. And then you have this area in the middle, which you can bring so many people inside. Sometimes you cannot actually differentiate between somebody who scored 299 and 3. Maybe they are the same companies. Maybe the 299 has some other characteristics. The other thing is the weights. The weights in any credit scoring model are unlikely to be constant. This model was when it was developed, the coefficient, which is the X1, X2, X3, was based on American data. And we assume this American data applies to all companies. But actually, if say a group of banks here or a bank started to follow the ultimate Z, he has to go and do the same methodology, and maybe they will come with different coefficient instead of 1.2, 1.4, maybe they will come with different coefficients based on their probability setting. So this is the second weaknesses. The third variable, we only limited to 5 variables, and we think this is what makes the customer actually default. Sometimes there is more than that, and there is also, these are not constant over time. It's actually, in any credit scoring model, it's not likely to be constant over long period of times. Maybe some other variables come to the formula. And of course, the model ignores the quantitative measures, like all these issues. They don't consider them. So you can calculate, and then you can later on take those variables to the picture, but the model does not take it. If you are going to work what we call hard information, which means you just key in the numbers in the balance sheet and give the decision, this other qualitative one actually are taken out of the picture. This is what I want to see, and this is actually the end of part 2. This is the end actually of part 2. So this is the end of part 1. I'm sorry. Thank you. And I will stop here. Bye-bye, and see you in the second part.